Greetings, fellow investors. I'm Matthew Cochrane, a lead advisor at Seven Investing, where it is our mission to empower you to invest in your future. We do that by providing monthly stock recommendations to our premium members and educational content that is freely available to everyone. Listeners, today I am very excited to introduce Ryan Krueger. Krueger is the co-founder and CEO of Freedom Day Solutions, a family-owned and operated financial advisory firm out of Houston, Texas. He writes excellent blog posts on his site that I always enjoy. He wrote a chapter in the book, How I Invest My Money. And he's also starting an ETF, ticker symbol MBox. And we're going to talk about that a lot today. He's one of the most entertaining and informative follows on FinTwit. But more than that, he's just going to be one of the most nicest and most genuine people you're going to find on Twitter. And he can be found at Ryan Krueger ROI, where you can find him posting about everything from gratitude and sliced bread patents to dividends and disruptive technology. Ryan, welcome to the show.
Wow, that was the kindest intro from one of my favorite people. Thank you. I'm thrilled to be here.
Well, thank you for joining us. And for those who don't know, I enjoy my interactions on Twitter very much, and I enjoy everyone who DMs me and comments on my post, and I love the back and forth. But there's maybe 2 or 3 people who from Twitter who I consider real life friends, and Ryan, you're one of those people. So I'm thrilled to have you on today.
Well, you and I and our relationship's a great example of the of what's good out there, and if you live in a world of abundance, and I'm a digital dinosaur. I will never forget walking back in after my intern asked me to post something on Twitter for the first time. And this is only a couple years ago. Right. And I had to ask him, what is a notification? And somebody had taken one of the blog posts and shared it. And all of a sudden I had a lot of new friends, but a very few, like you just said, who there's a true interaction back and forth. And I've never had, and maybe I'm an oddball, but I've never had a bad experience. So for all the negative, I guess you can find that if you want it too, but I have nothing but positive experience in sharing. And this relationship, I owe it to that. So I'm grateful.
Yeah, absolutely. Absolutely. Ryan, how about we just start? Tell us about your career. I know you started on Wall Street, but your story about how you got from New York to Houston is very interesting. So why don't you just share that if you don't mind?
Well, I interviewed somebody 15 minutes ago, just before jumping on here, and I made my confession, and my fondest wish for her or anybody is that they will never have to use a resume again.
Right.
And that comes from a very biased point of view. Matt, little barroom trivia on me, I never produced and never had a resume. So with zero other interests out of school, I was a rabid stock market nerd from junior high on. That's what I wanted to do and figure out. I was immediately told we have zero interest in hiring somebody without a network or with no experience out of college. So I was refused the interview. And so I never had the need to produce a resume, but I wrote what I call to this day, a Hail Mary letter. Not advice, doesn't always work, but in case it helps anybody out there, at least be a little more relentless. I just simply asked if I could come and visit with anybody at the office. And I very politely was able, thankfully, to a kind gentleman there, able to do that. And I never left. And I agreed to start at the minimum, start in the mailroom. And I spent the next 14 years at what was then the largest global bank brokerage. I was on the professional money management side very early on. So I was able to research stocks, managed a discretionary portfolio. So thankfully, and a lot of luck, to not have to go through a whole bunch of different jobs and mazes. And that's not for everybody. I think a lot of folks will benefit from a host of different experiences. For me, portfolio management was what I wanted to do. And thankfully, I was able to learn a lot early on. And then in 2006, launched our own firm and left. And that's where I still sit to this day. And now we're super excited and fortunate for the next phase to be able to open up a couple of offices outside of just Houston and turn this into a national brand.
Excellent. So now, Tell us about this new ETF. The symbol is MBOX, and I'm sure you can tell us what the significance of that ticker symbol. But like, tell us, like, yeah, just give us your why the need for another ETF, and like, what's the philosophy underlining it, and how did it get its name?
Great question, as you always do, straight to the heart. And if people are always surrounded by your politeness, I will add the directness of your question. There is absolutely no need for another ETF. Let me be clear. There are too many of them. My entire career of 25 years, we've never launched a product. We've never owned an outside product, a fund of funds, any of these complicated solutions of any kind. So the answer to your question, I had zero desire to join in that complexity or confusion. But because of the advisory side of our practice and because of humbly learning for all those years what good old-fashioned families, investors' biggest need was, I think there was a problem to solve. So I wanted to solve a problem, not create a product. And in our opinion, that is going to be an increasing need for, rather than another growth ETF or income ETF or allocation or more confusion and more questions, I think people are going to need growth of income, not more choices for growth or income. So to answer your other question, MBOX is our polite tip of the cap to the folks who made this possible, that hired us over the last several years to give them good old-fashioned mailbox money, as we call it down here in Texas. And that concept needs to be more universally understood. And yeah, it's simple and it's old-fashioned, but you know what? Some simple and old-fashioned things stick around for pretty good reasons. The name of it is Freedom Day Dividend, which means a lot to us because we want to completely turn upside down this notion of retirement planning and a date and an asset number, rather the day when income to that mailbox is in excess of invoices going out. So that is our definition of Freedom Day. And I do think it's achievable because I've seen it.
Excellent. And so let's talk about your philosophy for a little bit, because I've heard you before, and I mean, I've read your material and I followed you. But for those who are not familiar with you, like, why is that so important? Why is getting those more figurative checks in the mailboxes like more important than like a growing portfolio or things like that? Like, why do you consider that so important?
Well, I never think, and I think this is a mistake for a lot of investors and portfolio managers, certainly in the business of selling investments, and that's not what either one of us do. We're sharing ideas, but this should never be about what I think or my prediction or my belief system or my bias. The answer to that question happens to be as a result of simply learning. So for 25 years, I've had the opportunity to manage aggressive growth portfolios. I've had the opportunity to manage a long short hedge fund with the most complicated options, futures. I've touched and seen and done it all. And thankfully, all successfully. And I don't say that to brag because I closed some of those down. The reason is that simplicity was the holy grail. In my opinion, there's one metric that has stood the time for 200 years. And I just learned. I kept digging, and there's nothing in the world wrong with, and why do you think I listen and follow you? I want some growth assets. The need we feel, and the biggest problem for the most number of people that I think is hardest to solve, though, is rising income streams where you don't continue to have to speculate and grow assets more and more. And then one day, and the real problem out there, I think, for financial planners is going to be, I think this withdrawal rate from growing assets is in significant trouble over the next 40 years. I mean, we've had tailwinds at our back from a bond market and fixed income for those plans that we're not going to have over the next 40 years. And I'm also biased by learning and humble to know that stocks don't always go up either. I mean, the day I got married, to probably the biggest secret of my success and the most important of either one of our plans, as I always say, is who we marry. The day I got married, the stock market was exactly where it started 12 years later. So the big answer to your question is, what if people are counting on, and they're not in the net accumulation, aggressively saving, and it doesn't matter, I've got all the time in the world. At some point, whether it be near halftime of somebody's life or when they eventually want to be reunited with their money, they're going to need the ability to generate free cash flow. And if that's one of the simplest and best ways to look at a company, why not look at an investment account and demand that of your own plan, the same way we know works for companies? And I don't think enough investors are asking themselves that question. Where's my free cash flow?
Right. So like, I mean, and to your point about like getting married and then like 12 years later, the stock market was the same place. Like, so at the depths of the 0809 crisis, if you were retiring, then, and you have seen this like huge drawdown in your portfolio, but oftentimes those companies, if they're paying a dividends, they did not see, if you're living off the income from those dividends, you're doing just fine.
Yeah. That chart that I keep on the corner of my desk for a lot of different reasons. And next to one of my many favorite trading quotes is, no matter how elegant the design, occasionally check the results. And that lesson is, no, the stock market doesn't always go up. And there are a lot longer periods of time than most bulls or bears like to really think about, that it goes nowhere. And I think that's the most unasked question. It's not a prediction, by the way, it's just it's the math that we need to solve for. So over that period of time, one of many different stocks hiding in plain sight that, for all the correct concerns about no active manager being able to outperform an index, the S&P being the most popular one, I hit that, very serious and valid concern right off the bat, is rather than promising any sort of track record to make a prediction, I would just look at the parent company of that index, S&P Global, that raised its own dividend every single year during that period where the S&P that everybody was staring at did nothing, let alone periods where it goes down a lot. There's a lot of investors that aren't even familiar with the parent company itself. So do I believe in passive investing? Absolutely. I want to own the whole store.
Right. So a lot of times growth investors, they criticize stocks that pay dividends, like saying that companies that pay dividends, they don't have other ways to invest their money, implying that stocks that pay dividends, like their growth days are over. Like, how would you respond to that?
I was one of those, Matt. I think that's a valid concern. And I think there are a lot of companies where that is absolutely correct. And the work where we started rolling up our sleeves to start separating companies, no different than you do on the growth side, is which companies are aggressively growing their dividend. And yet there are companies that are making more cash than they can put to work. They are investing. So I want to look at R&D. Are they reinvesting? Are they aggressively adding future growth? Are they paying down debt or buying back shares, and they still have enough left over to reward stakeholders? I think it's a valid concern. That's why there's so many dividend companies I want nothing to do with. But the best clue I've ever found in all of those metrics, and we still use 36 to score every one of the stocks, is if you're increasing that dividend consistently, that shows me two things: improvement in a company and how they think of and treat stakeholders, which, yeah, it's an old-fashioned idea anymore, but I actually think now more than ever, when there's a lot of questions about what is real in investing, never before have those questions been crazier than right now in my career. A dividend is real. I can hold it in my hands for over 200 years. That matters a lot to people, that some of them don't want to ask all these questions about the stock market. And that is a simplifying clue unlike any I've found.
One of the, when I was early on and making several mistakes in investing, one of the mistakes I made at a certain point after getting burned by like story stocks and things like that is I was like looking at dividends. I thought, oh, this is way easier than like trying to find out like what the next big stock is. I'll just pick the stocks with the highest dividend yields. Like, well, that's easy, right? So if a stock's paying 8%, just mark it down. I got 8% returns like going into perpetuity. Why is that not a good strategy? Why can't investors just pick like the stocks with the highest dividend yields?
There's a lot of reasons. One of the simplest way to describe it, I call it my Don Vito Corleone discipline. What have I done to earn such generosity? Those yields, no different than a lot of other businesses, if you think about it. If they are the ones flipping the signs on the side of the street, trying to attract your attention, I'd rather find the store or the restaurant right behind them that isn't advertising and has a line out there's high yields that are not growing, are one to they're not very exciting, and you're right, and there's not a lot of potential. Oftentimes they're the biggest red flag for underlying issues. They may be funding that dividend with debt, not growth at all. And that's one of the ways that we would separate. And I think even some of the very popular dividend strategies, the most popular of all being the Aristocrats and the Dividend Kings, that one of the many reasons that we launched this ETF is I think there's a better way. Some of those traditions of just keeping the dividend for the sake of selling customers that story, if you just pull back even a little bit of the curtain and do the math of if that dividend is growing from debt, not operating revenues, that's a problem. If there's no free cash flow and they're sending you free cash flow, that dividend is not sustainable. So we look at not just the payout ratio, which is a popular measure from earnings, but we would much rather find the payout ratio from free cash, which is a little harder stress test on a dividend. And we want plenty of cushion to not just support the dividend, but that it grows. And one of the most misleading parts, another secret hiding in plain sight, Matt, is for, one of my favorite charts is you take a popular dividend yield of 4% and a very boring only 2% dividend that's growing faster, and show the crossover point where you're actually getting more as a stakeholder in your hand. And I sent you one of those where it's like you end up with more money from a company that was only yielding 2% over 10 years than one that was consistently yielding higher. And that's very confusing to a lot of folks unless they follow the very simple mailbox math of the actual dividend payments held in your hand. And you can make more money from a low yielder if it's growing faster.
Absolutely. You brought up payout ratio. Explain that what that is for like investors who or people who might not be familiar with that. Like, what is that?
Well, so in a lot of these simple online services that folks and some of your subscribers are more sophisticated than a lot of analysts I left behind on Wall Street, and I really do mean that sincerely. I mean, they're going to be able to find easily, payout ratio. And typically and traditionally that's from earnings. So I want to be real clear here. And so you could see, frankly, some of these big yielding companies, they may have a 500% payout ratio. That's a problem. That means they're paying out 5 times in a dividend of what they have in earned income. So if it's 50% payout ratio, then they're paying out a dividend that is very well supported, right? They have $2 of income and they're only paying out $1. That's a 50% earnings payout. What I do that takes a little bit more work, that's not quite as readily available, is I just want to make it from free cash flow. So the same math, if $2 in free cash flow is coming in, and if they're paying out $1 of free cash flow, that would be a 50% payout from free cash. And if you have an aggressive growing dividend and a low payout ratio, you have a really good clue of future potential, especially if it keeps growing, for more increases. And that's where the real magic of mailbox math occurs, future increases of dividend, not just the current yield. Did that answer your question on payout?
Yeah, no, absolutely.
That's one of the best, easiest red flags to look for. There's plenty of very popular, widely held companies. Some of the biggest holdings in some of these dividend ETFs that have unsustainable payout ratios. They will be cut.
And we're striking at like one of the heart of like my biggest criticism of the Dividend Aristocrat like strategy, or the Dividend King, like, which are just companies that have paid like a rising or have raised their dividend for 25 straight years or 50 straight years. Is that a lot of times when you look at those lists, you'll see some of those companies, you're like, that company seems like it's kind of struggling now. And instead of just blindly buying it, if you look at like some of those raises over the last several years, they'll like raise it, they'll give it a nominal raise so that, they raised it by one cent this year or 2 cents the next year or something like that. When really they're just trying to they feel the need to keep that strategy going because they want these investors in their company. But at the same time, the business would be much better served by even one, just stop raising their dividend, or two, even cutting their dividend to invest in other areas that they need to.
That's a great clue that you just hit on the head. If you see a 1% or even less than 1% dividend pay raise, you should immediately know that's for show.
Right.
And that starts to pull the curtain back on one of our bigger differences, I suppose, with a lot of the professional community, talking about how wide is the moat, and some of these traditional companies that have a big advantage, and they've always had a great company and they have a big advantage, they have a big dividend. That is less interesting to me than the direction of the moat. So a big dividend or a big company that is no longer growing, the thing about moats is they can spring a leak too. And you can start to see that in the numbers. And I just watch the math. I don't try to predict futures of businesses, but you can start to see erosion in moats. And I'm much more interested in a lower yielding dividend with a big increase than I am a fat dividend, a big moat with, as you just said, a very tiny increase just to keep the tradition alive. That comparison right there is a giant difference. And the other thing about big moats is they attract crowds, whether it be competition that won't allow it to continue, or investors have crowded into that moat and they've bid up shares and they're too expensive. So I'm much more interested in the direction of the moat than the size of the moat.
Absolutely. Let's talk about some of your holdings in the ETF, and just looking at your top holdings. Can't help but notice your first holding is EOG Resources, which is an energy company. So is this just like a Texas guy who likes energy, or what's the story here? Why is EOG the top holding in your portfolio?
Well, so, and I don't have a cowboy hat. I've never worked in a field, and I've actually offended many of my oil buddies down here in Texas. I didn't own energy companies for over a decade. It was very clear that there was a secular decline and a lot of problems. And as we just talked about, a lot of the math made it really clear, especially on some of the bigger ones, that they were fueling, whether it be dividends or growth projects, with debt, and their operating revenues weren't there. And there was a lot of problems. But no different than obvious advantages, problems can get really crowded too. And it became so obvious that in my 25-year career, I've never seen an industry with such obvious questions and issues at the same time, because of ESG, literally forcing institutional shareholders to sell, whether it was at the worst time of the bottom or not, put that aside, but forced selling should be just as curious as everybody knows about bubbles and how they inflate from buying without questions. Well, if you're selling without questions too, at the very least, I pulled up my chair with a sharp pencil and re-examined some of the businesses. So to answer your question, this was not a bet, and we'd made it a largest position. I think anybody's largest position, if they're doing this on their own, should be the result of an output, not an input. So the portfolio starts balanced, and the fact that you're seeing right out of the gates that it's a little bit larger than others, and you're correct currently. I think that, and I'm just if none of my predictions that I'm about to share or curiosities work at all, the math still suggests that there's some really good free cash flow dividend growth stories sitting right under our noses that we've completely ignored. And energy went down to something like 2% of the S&P 500. I mean, literally given up for dead. I wonder, and one of our projects over the next several years, I think it's going to be very surprising if some of these dirtiest companies, by the way, that are not all bad and they're not all run by evil capitalists, who might know better than the rest where the problems are to fix? I don't think ESG has all the answers. And I do think there will be some old-fashioned dirty companies that could be part of the solution. So look, like you, I have a bunch of kids. I'm more interested than anybody in this planet being the safest, healthiest, happiest place for many generations to come. I'm just not eliminating from consideration that we know exactly who the problem solvers are going to be. And I have an open mind, and the math says we can get paid pretty well to solve some of these problems.
Sure. And I agree with you. I mean, and those energy companies have definitely been beaten up in recent years. I think the first company we ever talked about, Ryan, on Twitter, and I think this is how we met, but like we were talking about Domino's Pizza, and like I think it was a comment that I put that it's the only place I can get dinner for my entire family for about $20. And then you were showing me your Noid souvenir that you, or memorabilia that you got on eBay before we started recording. But like, so let's talk about Domino's.
Well, as is often the case, and one of the reasons we collide in a lot of fun rabbit holes, and that was actually a historically successful growth stock for many years, that is a phenomenal success story. And the rabbit hole I happened to be on, believe it or not, was just the history of the founder and how you and me are going to make sure our kids have uncomfortable summer jobs like we grew up doing, and what in the world has changed between that generation and that story and his story that I humbly shared and learned from. Again, this wasn't a stock recommendation or a pick. It was me learning, and along the way, and that's just the nerds. If we happen to be able to figure out some places to invest, or that opens up another door to another rabbit hole, I just happen to find that research so much fun. And I think that's what makes your group so special too. You can genuinely capture the excitement, the optimism. This can be a lot of fun, the work, and that's wildly underrated business idea, by the way, in any industry. So Domino's, and I love that heritage, that culture. I mean, I think something like 95% out of all the franchise owners started out as delivery guys.
Yeah. Oh, they start off in store. Yep.
And they became such an unbelievable turnaround story, which was the reason I shared that. I mean, they were universally voted, this is many years ago, as the absolute worst pizza. And they not only dug in and said, how can we improve this? They literally rented out billboard space in Times Square showing they were the worst and tracking their progress. Humility is a secret ingredient, and that caught my attention. The growth did, but then when they started turning into a free cash flow generating machine, this is a good example of, I mean, you're not cherry picking one of the better yielding stocks and the holdings we have. It's one of the lower yielding.
Right.
But when you're growing your dividend at 15 or 20% a year, your dividend in 5 years or 10 years could be higher than that big utility or higher yielding stock is today that never grows. So that only 1 or 2%, the math is quite clear. You could have a 5% dividend in a few years or more. I mean, we have, and you probably do too, some of these great growth stocks, if the stock goes nowhere, if the stock market stopped going up, I mean, you can have double digit your dividend yield for the rest of your life and growing. That's appealing and overlooked math. That's why we call it the mailbox math.
And it is. It was such a great story. Like I was actually listening to this podcast series on Domino's and like their history. And so like in 07, 08, they were already kind of struggling. Consumers weren't liking their pizza. And there was like a very early on, like social media scandal they were involved with because 2 of their workers recorded a video of them like doing like horrible, disgusting things to a pizza. And like the story is like that pizza actually never was delivered. Like these workers were just making like a prank video, like but it was like blowing their nose in the pizza or something, stuff like that. And so like online, like people were like, well, the comments on like that video were just brutal. I mean, just completely brutal. Like, this probably just tastes like any of their other pizzas that go out and things like that. And that's when they knew they really had to change things. And like, you have to give them credit for that marketing campaign, just how they were like they would hunt down customers who left them really negative reviews and like say, try our new pizza, you know, and
well, and he was a servant leader. The guy who gets a lot of credit for that, Patty Doyle. I mean, he started out,
yeah.
that post started out like he was a busboy, and it's how you take care of people. He didn't start out as a CEO, and it was also a post to inspire folks and to give permission maybe to young investors or young workers that are sitting around with a bunch of empty pizza boxes trying to figure out the next great idea. And it might be the empty cardboard box right next to you.
Right. Yeah, for sure. Yeah, but it's a great story. I mean, even today, like in your neck of the woods, they're experimenting with autonomous delivery, like pizzas, like with like this robot with like a pizza warmer in it, and they're like they're delivering pizzas that way. But you know, they never. What I love about that company is they're never afraid to experiment with things like that, and some of them are probably more gimmicky than practical. But I love the experimentation that they do with just like different delivery techniques and their app. They have a zero click app, which before we moved a few years ago, my wife would use because she knew exactly where in her commute to hit this button. So that when she passed by the store, she knew the pizzas would be ready. And it's just like you save your preferred order from your preferred store, and you just click the app and it starts a timer. And when the timer goes down, it just automatically orders your saved order, you know, and she knew exactly where on the highway to hit that. And she wouldn't have to look at it again and know she could just stop out at the nearest store when she was coming home and the pizzas would be ready.
It really turned into a technology and efficiency marvel more than a pizza recipe that worked. And some of the best advice I've ever gotten as a business operator is give me an execution guy or gal over an idea guy or gal any day, because they're far fewer. They're very, very low supply.
Absolutely. Another company you hold is Broadcom, which is a technology company, but it's often overlooked. You know, and it's like kind of like one of those sneaky semiconductor companies that you don't hear much about, but has delivered great returns for shareholders over the years.
Well, this is happens to be a story near and dear to my heart, but I'm loyal to no background, and I think it's a great example of companies that can change. And I'm just interested in the math, but the fact that I go a little bit ways back, and it's a good example. I'm sitting in 1999, early in my career, literally on the edge of the pin, about to pop the technology bubble. Could have only known this in hindsight. Obviously, I didn't there that day when I'm in my fancy Wall Street suit trying to impress a new client, completely oblivious at that time. I'm a Texas kid. I didn't know what Buck's restaurant was, sitting there in Woodside, where all of these companies that we now read books about were formed, or a lot of them. The Tesla prototype was in the parking lot. All of these different internet companies were on napkins all around these tables. And I'll never forget this, the morning, because the humility that I was sitting with is a lesson I've still learned, and something you and I have in common. And it is absolutely a good a good piece of any investor's playbook. That guy that day said, I've had enough. I know I need to diversify. I know I need to balance. I was fortunate to be recommended because I knew other things besides technology, which is all he was surrounded by. And he had just sold his company to Broadcom. And that was at the height before they all crashed. And that day, the largest private real estate transaction right up the hill consummated. And what we now knew, and looking back, was that was the day that particular bubble started to burst. And had I been a believer in technology or semiconductors, or dug my heels in and just studied an industry, or stayed biased in any way over that period of time, I'm not sitting here with you today. Instead, just having an open mind and being curious, and many, many, many years later, that same company appearing through some of our quantitative screens that just push us candidates that this math is changing. This business might be changing before people recognize it. And they turned into a cash flow generating machine. Recently, qualifying on one of our stock tournaments that we hold when these tickers stop moving around on Saturday mornings when I get a couple of quiet hours. It was a 5-tool prospect, as I like to say, when it exceeded expectations, bottom line, top line, raised guidance, and yet was still cheaper than the market and outperforming their sector, identifying possibly an uncrowded and still misunderstood story. And they're not alone. But to answer your question, that's one that I was smiled at when I saw come through the tournament 18 years later that I got to reunite. And I think more than the stock should be a lesson to anybody that active management has a lot of upside and open mind, and the fact that companies change. As long as you have strict sell disciplines, that's the best of active management, that things change, and you should have buy disciplines too.
And let's talk about one more of your holdings. And we actually talked about this today on our show, was Tractor Supply. And you told me before we started recording, they didn't close one store for one day during the pandemic. Is that true?
That's true, to the best of my knowledge, and we did have it confirmed. I wasn't at every one of those stores, Matt. I do have a house full of pets and people, and we do serve a lot of gentlemen farmers. That it's funny, the folks that work their tails off to get off the farm down here in the South, and when they have a few bucks, their fondest wish is to get the heck out of the city and to go buy a little farm.
Right.
And that rural movement in some parts of the country, I guess, might still be chuckled at. But if you look at the migration patterns, and if you study the U-Haul indicators like we do, it's real. And I don't like to ascribe any extra credit or even feel comfortable talking about these pandemic stories and what was pulled ahead or pulled forward. I think some of these facts that were in place and desires that were in place, the fact that they may have been accelerated and more people found out about all these people moving in the country, certainly may have made it a more popular story. But this was underway for a lot of good reasons. And I'm here in Houston, and several million of my closest friends and mosquitoes in this swamp. There's a lot of good reasons that people like to get into rural, less crowded spaces, and these stores are doing phenomenally well, serving folks with some of the simplest of needs. And that was, I think they have a lot of room to go still too. I think open spaces and migration patterns in this country over the rest of our lifetimes is going to be fascinating. And they won't be the only ones to benefit from it, but you need to start drawing circles around, not just the big bank in the city, but who's the only bank out here, who those businesses, and a lot of them we drive right by, as you said. And when you got to be stuck at one of those, actually, I shouldn't say stuck. I don't know if one of your family members listening, but whatever the event was, the family, the wedding, or keep your eyes open.
Right. Well, so I was at a niece's wedding in Killen, Alabama, which is in the northwest corner of the state, as best as I understand the geography. And so it was a lot of driving off the interstate, and it's a place we wouldn't have gone to visit normally, but you know what? We had a great time. And then after the wedding, we went to Lake Guntersville, which is also in northern Alabama. And again, a place we would have never, ever gone to, like, if it wasn't for this wedding. And yet again, like, we had a fantastic time. And so but driving back, so you'll be interested in this. So driving back, we went through all the country roads and things like that. And you start to see these stores that aren't in my local area, but you'll be interested in this, Ryan. So there's a 2018 Gallup poll that asks where Americans would like to live. 27%, more than any other category, said they want to live in a rural area. And only 15% of Americans actually live in a rural area. So not only was it the most popular answer, it was also the biggest gap of people who want to live in a rural area and the people who, who want to live, but who actually live. And now with remote work, it's not just people retiring now and saying I can go live in a rural area now. It's also people saying I can take a little bit of less salary and still earn an income, and I'm going to move I can sell my expensive house in the city or the suburbs and move out to like the country and buy a house for a lot less and and live a better life, the life I want to live. And so Tractor Supply, I mean, for those who don't know, it sells like agricultural supplies, like, people who move out of the country, they want to have a chicken coop and they need chicken feed and the supplies to build a chicken coop. And so it sells all those things, and it sells like tools and things like that. And Poland Capital, one of my favorite money manager groups that I like to follow, they have this concept called a moat attack. And so they said you can never really know a company's moat until it's been attacked by a competitor and withstood the attack. And so they bring up a few examples. One of the examples they have brought up before is that Home Depot tried to like launch a concept that's similar to Tractor Supply about a decade or so ago, and it failed utterly. It utterly failed. Like Home Depot abandoned it after a year or two, and Tractor Supply has done a marvelous job, not only rewarding shareholders, but obviously really filling this underserved need.
And I think it's, if you're in a big city or are not familiar with these drives, it's also one of my favorite opportunities in the stock market when you find them. It's a misleading name. They're
that's what my co-host said today. So we were talking about it today because they have a horrible name.
So anybody, especially stuck in a city or in an apartment, that you may have changed your buying and behavior habits over the last year. Did your pet?
Right.
So they happen to have a gigantic pet business. Another misleading name we were talking about earlier. So Smucker's is secretly a giant pet food beneficiary. A lot of folks not only took better care of their pets over the last year, but they have more of them than ever before. And I think there is a common, slow, secular theme of the beauty of simplicity. And when you are walking your dog out in the country, and things are slowing down a little bit, which is, golly, harder than ever to do. But I think you bring up a good point. I mean, that's how, believe it or not, I'm the worst retail analyst in the world. I don't shop. I don't know any. So again, the numbers have to come. But Best Buy was another one. If Amazon can't kill Best Buy, that's when all of a sudden I was like, wait, they should have been if anybody should have been in the crosshairs. And Tractor Supply was another great example. I mean, the Walmarts, the big boxes, those specialty niches, and room to expand.
Yeah, absolutely. Absolutely. So Ryan, let's end on this. When we first started talking, I think it came up that you are a father of 5. Is that correct?
Yes.
And I think you're the only one on FinTwit then that has more kids than I do. So I'm a father of 4, and it caught me off.
Said, there's no different level of crazy from 3, 4, 5. So there's no difference between the two of us. 4 and 5, we are full zone defense. Yeah. There's no difference.
Well, what's that joke? There's like an old joke, like when you have 1 kid, you can double team them. And when you have 2 kids, you can play man-on-man defense. When you have 3 kids, you play zone coverage. And when you have more than 3 kids, it's just prevent. You just try not to give up any of the big things.
And hey, no joke. And we've swapped stories about this too, and I share them when I can. They're some of my favorite little analysts too. And I don't say that cutely. I say that when something, and especially with teenagers, if something's annoying me, like video games did 5 years ago, I'm gonna dive down that rabbit hole. I'm gonna figure out what's going on here. And so what I've done is make sure that they have to also make a few of their own selections. And sometimes you can end up making more money with your kids than you try to do for them.
Right. So it's like that Peter Lynch. Like Peter Lynch used to say, like, to know what stores he wanted to invest in, he'd just take his wife and daughters to the mall and see what stores.
That's right. I remember I was a Lynch fan. Now it's just follow them to the couch and see what they're doing.
Right. Or what apps they have on their phone, or what apps they spend the most time with, or what they're playing, for sure. So that, like, this is kind of what I was going to ask you, like, how do you teach your kids about investing? This is something I've asked a lot of people. And so it's something I think a lot of listeners are very interested in. I grew up, my parents were great parents, but they didn't know anything about money. And so I learned at a much later age than I would have liked about investing and saving things away. So how do you teach your kids about money and investing?
I love talking about this with you all the time, and I've learned as much. And think that you're a heck of a father in person too. That's probably what I like most about you. The fact that we spend the rest of our waking hours down some of the same rabbit holes doesn't hurt either. But I think, that the chapter of that book, and he probably had the hardest time doing the sketch for me. Carl Richards, the great artist. I think one of the best lessons, and so the
So this
sketch
book
is,
again, how I invest my money.
the sketch is, and I'll make if you want to give one to your listener or in a listener, I will share one for your group if you want to do some sort of contest of the best kid investment idea, or however you want to do that. My job as a dad is I want to make sure this should not be about the investing or the stock picks. So the sketch for me is it's the work that's more important than the investing. And I think too many parents are skipping that step. I know they are as investors. So the best way we can do this is at the supper table and talk about this stuff. That's number one. So my favorite game there is, of all the different great ideas and what I need to learn and stay young on, like video games we talked about, my favorite question at any age is, will you try to name, there's 5 of them there, everybody's got to name one business that will still be in the same business when you are in my chair as a dad. That's a harder question than even most professional money managers would like to believe if they really think about it. There's far fewer of those than there are game-changing ideas, the game unchangers, as I call them. But then the harder, sweatier, grittier way I like to teach them that we're doing this week. So I'll get back to you on how well it's worked. It may be a miserable failure, who knows? But I said, I'm going to back you, not on a stock idea, but we're going to do a power washing company. And we walk through the math of buying the equipment and the payback. And they said, that's, when we do lemonade stands at my family, it ain't the revenues are the earnings. No, there's a cost of goods sold.
Right. Yeah.
And then we're going to give some away, keep some, but we're going to walk through the whole actual business. I think hard work is the secret missing ingredient for more kids than when we were kids, because all it's going to do is make investing even more appealing. The idea that, wait a minute, I can get paid while I sleep now. I want to get back to the dinner table and listen to that old man talk about stocks, because now I know how hard it was to get that dollar.
Right. Dollars are not easy to come by. For sure. Well, that's a great way to end it. Thank you so much, Ryan. If listeners are interested in learning more about you, where can they find you?
The same place you and I hang out, as you mentioned earlier, Twitter at Ryan Krueger, ROI. And by the way, that ROI is not the traditional. That's my tip of the cat. We flip Wall Street's version of ROI, which is what's in it for them, return on investment and keeping assets. That's my polite way of saying this should be turned upside down. Income, then opportunity, and what is the reason to invest? That's what that ROI means. We're at Freedom Day Solutions is our website, and I'm very grateful that you ask about the ETF. That's freedomdaydividend.com, symbol MBOX, and my personal biggest account. So you know where I will be after this and before we talked and what I'm working for. So it's an honor to share that with you, and I'm happy to answer any questions.
Well, thank you again so much for joining us.